Hello and welcome to episode 40 of Prosperity by the Pint, episode 40. So those of us that have been here with the beginning, I hope you've noticed an improvement, and we're getting better at this all the time. This is a podcast where we talk about money, investing, business, and life success, all while enjoying a cold beer. I'm your host, Brice Carter, certified financial planner, chartered financial consultant, and certified investment management analyst. Today, I have a very special guest with me. I'm going to let him introduce himself, but his name is Michael Riggs. Michael?
My name is Mike Riggs. That's me. I'm a senior strategist with State Street Global Advisors, and this is actually my 25th year.
25 years at State Street.
I am an old timer. Yeah, old timer.
Right. Well, I'm pumped to have Mike here. We're going to talk about State Street in a minute. We're going to talk about some ETFs. We're going to talk about a lot of things. It's going to be fun. But as always, the cold beer portion from Alpena, Michigan. It actually says the scenic Alpena, Michigan, Austin Brothers Brewery, the 45er IPA. And they call it the 45er because Alpena, Michigan is on the 45th parallel. So that's fun. So we'll give this a few tries. It's a 7% IPA, and I'll let you know how we like it at the end of the episode. But thanks for being here, Mike.
Thank you.
So those that don't know, what is State Street? State Street Global Advisors, State Street Bank. What are they?
Sure. Well, to start with, State Street was originally founded as a bank like we think of banks today.
Yeah.
But way, way back, more than 200 years ago.
I had to look this up, but State Street is the second oldest continuously operated bank in the United States.
Yes, and we still hold a bank charter. But probably about 40 years ago, we transitioned from a traditional bank, as you think, a retail bank, into doing banking for institutional clients. So those would be big pension funds, endowments, et cetera, and then basically doing what we call custody. So we do really the accounting for the investments of those large institutions.
And you're the or second largest custody bank in the world, is that right?
Yes, we are. That is correct.
Wow.
Yeah.
So that's a lot of money. I don't know what the custody bank world looks like, but we're talking in the tens of trillions, or
you're talking in the tens of trillions for custodied assets.
That is
at State Street. Yeah,
incomprehensible number.
Yes. I always like to say, if you think a trillion, just think of a billion. You couldn't count to a billion in your lifetime, so a trillion is a pretty large number. Yeah,
it is. Well, this is good. I like this beer. So you've been with State Street for 25 years, and what do you do there?
So my role really is a product expert, an ETF, exchange-traded fund product expert, and we help advisors and institutions implement ETFs into their portfolio to help them meet their goals and their objectives for investing.
Right. And so your job is to go and meet with financial advisors and other institutional, not direct consumers, not the end consumer.
No.
And teach us, I'm saying me as a financial advisor, a better way to use ETFs or how to use them or what types we should be using and so on and so forth. On behalf of Spider, which is that an actual other company besides State Street, or is it just a brand?
So Spider, the original Spider,
Yeah.
which was the S&P 500, Spider was an acronym for S&P Depository Receipts.
This is probably a good point to interject and say that State Street actually invented the ETF. I mentioned that a couple weeks ago on a previous episode when we talked about exchange-traded funds. Actually, I think I mentioned it a couple times. You guys invented it in the United States.
That's correct. Yep.
Yeah.
Back in 1993, the tick SPY, the very first ETF. Today it's the largest and most traded in the world.
So today that acronym still lives on as the brand of ETFs for State Street.
That is correct. We've just used it as a brand for the remaining of our ETF lineup.
Okay.
Yep.
So I guess one of the things that I wanted to talk to you about, because I've done a couple different things on mutual funds and ETFs, is, and you have intimate knowledge of this, State Street has mutual funds as well, but primarily known for their ETFs, at least for the consumers, is the advantages, pros and cons of the mutual fund versus ETF world.
Yes. Yeah. So the biggest advantage is that ETFs we refer to as low cost, which means there's a cost to owning any single fund, whether it be an ETF or a mutual fund. In the case of SPY, the ETF that we discussed, it's 9 basis points. And a basis point is basically 1/100th of a percent.
So 9 cents on the dollar.
That's exactly right. Yeah.
So, in contrast to mutual funds, which are, I mean, I think this probably we would say, it's hard to know what depends on the metric you want to look at, right? Because you have active mutual funds, which are much more expensive. You're talking, $1 or 10 cents for every dollar for index funds, and significantly more than that for active funds, right? So, are you talking the main benefit of the ETF being the fact that they're lower cost, or in comparison to mutual funds, which can be active or passive or indexed, they're even less so than index mutual funds?
They can be even less so than index mutual funds, and actually it's a lot less than 9 cents on the dollar. It's more like 9/10 of 1 cent on the dollar. But yeah, the benefit is, and we'll talk about the S&P 500, is with a single trade. Yeah. You own the entire U.S. marketplace. You own basically 90% of the entire U.S. marketplace with that one single trade.
Right. So as I think we've kind of seen this play out, the advantages of ETFs essentially speak for themselves because of the market growth that they've, I guess, experienced and outpaced mutual funds on growth, right? Do you want to talk about that at all? I guess the proliferation of ETFs?
Yeah, so really, again, we think that the gravitation towards ETFs have been twofold. So the biggest has been the cost advantage. So again, when you buy an active mutual fund, you have to pay somebody to manage that fund, and that cost is high. They have analysts, et cetera. But when you think about how many active professional investors there are in the world, there's a lot. They're all competing against one another. So the data basically supports that it's very difficult to be above average for a long period of time.
Right.
And in fact, what ends up happening is everybody becomes average at some point.
Well, there's a lot of smart people competing against each other in the investment world.
That's exactly right.
There's not really any dumb people that are running mutual funds.
Right.
I mean, it's just by, there's just not. And so it's super competitive. And when it gets super competitive, it reverts to the average. And so I don't know why you would want to pay extra for average when you can buy the average for a fraction of a dollar, right?
Yes.
A fraction of a fraction.
Yeah,
right?
and that low cost basically helps with performance. The more a fund charges, the harder it is to have a better return because you need to take that away from the investor.
Right.
That cost.
So we talked a little bit in a previous episode I did about the free trade world we're living in now, where most of the major custodians, it doesn't cost anything to buy or sell ETFs. So then what are the key differences you're looking at? And I know there can be concerns with certain ETFs around liquidity, whether you can try to sell it, but doesn't mean there's always somebody there wanting to buy it, or you might not get the fair price. So what does that mean if you have a liquidity advantage or disadvantage?
It simply means it's the popularity of that product and how much it's traded among buyers and sellers. When there's a lot of buyers and sellers for a particular product, then everybody basically, the charge for that product has to be very close to its price. Right? So you think about just anything you might buy in the store that you could get at Target or Walmart. When you see it in every store, the price is generally the same.
Right.
But when you see a product that doesn't exist, maybe in one of those stores, the cost becomes a little bit higher. So when we talk about liquidity, the more liquidity, the less the cost to actually buy and sell that ETF. The lower liquidity, the higher the cost, because there's not a lot of people who want to buy and sell, and supply and demand economics.
How would everyday consumer that just wants to go out and buy an ETF and set it and forget it, which is something I recommend, buy it, reinvest, auto invest, good financial planning practices are not to get in there and day trade, is how would they know whether they're buying an ETF with sufficient liquidity or demands, right? How would a normal investor know that?
It would really come down to the spread. So if you have a brokerage account and you go to buy a particular product, you'll see two quotes. You'll see a quote, the bid quote, what it costs to buy, and the ask quote, which is what someone wants to sell it to you for.
Why don't they just call it buy and sell?
I don't know.
The buy quote and the sell quote. So they get the bid and the ask, which is buy and sell quote. And the spread is, so let's use a specific example. If I was going to buy this beer and the purchase price is $10.
Yep.
The sell price is
higher than that. right? They want more. Whoever's selling it wants more than it's actually worth.
So the person selling it wants $10.02.
Exactly.
And a 2-cent spread is not that large on this beer, but if you're trading tens of thousands of mutual fund shares, or even a much smaller number, but that's your retirement savings, it matters.
Absolutely, it matters. We've talked to some of our clients who say trading costs are as much as $40,000 of their practice over one particular year.
So that's financial advisors that are trading,
Yes.
For all of their clients, which that's something I know in my practice I pay attention to, but it really makes that whole $4, $5 trade fee, negligible. Now that's zero, but there's other costs involved in trading.
Absolutely they are. And that's what the spread is. The difference between what a buyer wants to buy that product for versus what the seller wants to sell it for.
So I think that's where and it depends ETF to fund and strategy to strategy, but some of your guys' products claim to have the best liquidity there is, right? I mean, like SPY is the largest ETF. So there's most people trading it, right?
Yes. I mean, it's clear. I mean, the data actually tells us that it is the most traded ETF on any one particular day. And the same with we have a sector lineup from technology to utilities, and they're among the most traded ETFs in the market.
Which means you're not guaranteed to, but much more likely to get a thinner spread, therefore a lower cost of trading.
Correct.
Right.
Correct.
And then you're buying the market at not just a low cost from an expense ratio, but trades are free now, and then you have you're buying it for a fair bid-ask spread, buy-sell spread.
That is correct.
Right?
Yeah.
So one thing I wanted to talk with you about, because you've been in investing, you've been with State Street 25 years. Is that how long you've been in the investing business?
It is. Yep.
Yeah.
Right out of college.
Right out of college. Okay.
Yeah.
All right. Where'd you go to school?
I went to school at Bridgewater State University.
Never heard of it.
Yep. And did my graduate work at the University of Massachusetts.
Okay. So you BA there, or would you end up getting?
Yep, I got Bachelor of Science at Bridgewater State.
Okay.
Almost completed a minor in math, a few short of that. And
I never would have guessed you were a math guy.
Yeah.
So then MBA. So then you got hired at State Street out of school. So one of the things I wanted to chat with you about, because the premise of this podcast is a lot of things around smart personal finance decisions, and I love having entrepreneurs on and talking to them about their story and going down that route of entrepreneurship. But when it comes to smart personal finance decisions, this happens to me more since I started this podcast now than even when I was just starting as a financial advisor and all my friends knew and were asking me questions. I get asked all the time about trading individual stocks, and I almost always recommend that individual investors shouldn't, just because I don't think a retail individual person has the capabilities to trade individual stocks in their IRA account and end up better off. Any thoughts on that?
I mean, I can tell you a personal story, actually.
I would love a personal
story. So I'm in the business. I should know, exactly what's going on in the marketplace, and I've learned the difference between a good investment and a good idea. So back in the tech bubble, in the late 90s, a lot of companies
I like that. I like that term. I gotta interrupt you. Good idea versus good investment.
Good idea versus good investment. Yeah. So there was a company came out. I can't remember the name, to be honest, but the ticker was HITS, HITS.
Okay.
What they did was you could buy your music online.
Yeah.
And you download it. And I thought, oh my gosh, this is it. This is what people are going to do. Yeah. And I was right. The company went bankrupt about 3 years later after that. And then probably 3 years after that, iTunes was born. So I had the right idea, right? But I had the wrong investment, and I had the wrong company.
And the wrong timing.
And the wrong timing.
Yeah. There's no difference between early and wrong in investing. Right?
And that's the story I learned, is that a great idea isn't necessarily a great investment. And today I utilize ETFs and funds themselves for my personal finance decisions in retirement.
And you're high. I mean, you have an MBA. You've been in the investing, one of the biggest investment management companies in the entire world. You work for and meet with financial advisors on a regular and institutional clients on a regular basis, and you just buy ETFs, not individual stocks.
I do, and I'll tell you, the reason for it is I don't possibly have enough time to know what companies might be the next Amazon, might be the next Microsoft, but they exist, and when you buy the market, you'll own them.
Right.
And you'll own them.
I mean, we always hear the story of somebody that picked those, but it's extremely difficult.
It's extremely difficult. Yeah. Extremely difficult.
I have there was one of the smartest investment people I've ever met. He's an academic, but he owns an investment firm as well. His name's Gary Miller. And he was telling stories about, to me one time, we were having a few beers. And when he started in the investment business, he was handling research, and he was essentially an analyst. And he said he looked at this company called Blockbuster in the early days. And he said, I just think that at some point somebody's going to be able to take their remote controller and click it at the TV and watch whatever they want, right? And not have to go to the movie, go to this movie store and rent movies, which is a favorite pastime for us millennials now. I'm surprised movie stores haven't come back. It's about the experience. Anyways, he said at that time if he had the money, he would have shorted the stock because he thought it was such a bad investing idea. And he was actually right? But he was about 20 years early because Blockbuster did phenomenal for a very long period of time, and then Netflix came into our world, right? And so one of the smartest people was not wrong. He was just early, and really there's no difference. Right?
No, there's no difference.
And I practice what I preach too. I pretty much just buy ETFs and auto invest and forget about it, and I don't look at my investments very often at all other than to look and see if I can up my contributions because, that's the idea is you can increase that over time. So we talked about free trades. We talked about liquidity a little bit. I always love the personal stories. And so you've been working with financial advisors for 25 years. Have you been in this role for 25 years?
This role I've been in for about 12 years.
Okay.
Yeah.
So any good financial advisor stories you'd like to share with the audience here?
So
I put him on the spot. This is not scripted.
The sophistication among advisors is as wide as the Grand Canyon. You have some that are very sophisticated, like yourself, who really know the markets,
and then
you have us who aren't as sophisticated, who truly, who truly want to do the best that they want for their clients, but aren't as sophisticated, as you might be, and so that's why it's really important to do your due diligence, when seeking out an advisor, because they're not all the same.
So I guess if you were looking for a financial advisor, or you had to find one for your brother or aunt or somebody, what would you be looking for?
Yeah, so the first would be, how long have they been in the business? Are they seasoned? Do they manage money for other people like myself? Was it a referral?
Similarities.
Also, do they have designations? Designations, do matter overall. So, and they basically tell you, how competent that person might be for this field in particular.
Things like the letters after your name. That stuff matters. It takes a lot. If nothing else, it takes a dedication to education to get those. Right. It doesn't necessarily mean that they might be smarter, but it certainly means that they're willing to take the time to learn to become a better advisor over time.
Absolutely.
Those credentials, right? Yeah. So we're State Street today. So you guys invented the ETF essentially, and you have the biggest ETF in the world, SPY. And you have, I don't know the number of products for ETFs or mutual funds. I guess just kind of lay that out for me. Where are you guys at? Where do you guys fit in the market space?
So we're the third largest asset manager in the world, and we're the third largest ETF provider.
Okay.
In terms of
is that a coincidence? The third of both, third largest.
It's not, only because on the other side we manage a lot of cash, so money market type. Money. So very different than the ETF marketplace.
Right.
But I have well over 120 ETFs today. Overall, about close to 600 billion.
120 ETFs.
Yeah, over
really?
120 ETFs.
How many are U.S. consumers able to purchase, like U.S. based?
All of them.
Oh, really?
Yeah, I'm not talking about
your international
the overseas
business.
funds and all. This is just the U.S. business. Yep. So, anything from individual sectors to some of our newest ETFs that we've launched recently that look at disruptive technologies like robotics or artificial intelligence.
I guess that brings up another interesting topic because we're seeing a lot of ETFs originally, and it's because of where SPY started with it just tracking the S&P 500 index, is we're seeing a lot of ETFs pop up that are now in a position where they're buying niches, right? And not just sectors, right? Like I've seen medical marijuana or marijuana cannabis ETFs. You mentioned what was it that you just mentioned?
Artificial intelligence.
I wanted to say biotech, but and Internet of Things. And you're seeing all these ETFs. Is there a place for all of them? I mean, it just seems like once you start carving up the indexes too much, is there just a niche for each one of these?
So for investors, we let them decide because if they don't invest in them and they just kind of linger, they eventually close. So we really let the market decide on that. But there are folks who have certain investment beliefs and philosophies, and those ETFs meet those beliefs and philosophies. So sometimes they can do well, sometimes they don't do so well.
Yeah, well, I mean, when you start getting into specifics, I mean that's a person that might, for whatever reason, have the need for that, right? I bet Elon Musk would be more willing to buy a artificial intelligence ETF than a guns and ammo one. I don't know, And so there's obviously if you're taking them to market, there's a market for them, but I've just, and this is just a personal belief, been a believer in buy the whole damn market, right? And you can do it so cheap, right? Like 0.03% is the cost of your guys' total stock market ETF.
Yes, I would completely agree with that because really no one has a crystal ball, essentially. I mean, the companies that dominated 20 years ago don't dominate today. When we think about the biggest company 15 years ago or 20 years ago was General Electric, which is now the 60th largest company. And in fact, 20 years ago, Google didn't exist.
What a fall from grace.
Amazon didn't exist. Amazon wasn't even the S&P 500. Apple hadn't invented the iPhone and I think was ranked 160th in terms of the size. And yet today, those are all top 5 of the largest companies in the world. You
know what I find interesting about almost all those examples that you gave is a growth in their market cap, right? Because they're the biggest names, right? And so inherently, when you buy a market cap weighted index, because a lot of indexes weight the biggest companies, the largest value, you end up undercutting the smaller companies, right? Because you're not putting as large a percentage on them.
That is true. But again, you have to think of what market cap is. Market cap is basically the value of a company. Right? Apple is worth almost $1 trillion, but it's worth almost $1 trillion because they make almost $250 billion a year. So they're large for a reason.
Yeah, absolutely.
The great thing about market cap weighted, though, is that as a company does better and does increasingly, their price goes up, it becomes a bigger and bigger part of the index. So
very true.
You captured the entire Amazon growth story in the S&P 500 because you owned it when it was smaller, and as it grew, it became a bigger and bigger part of the portfolio.
And I guess I'm not a huge fan of market cap weighted indexes just overall, but that's a debate and a longer conversation. But if you bought the Russell 2000 and you bought the S&P 500, S&P mid cap index, you might have owned it long before Jeff Bezos knew what he had.
True,
right?
That is true.
I mean, you owned it before it even got in the S&P 500 because Russell 2000 is a small cap index, so you own those really small companies. And
that is true.
The Russell mid cap index is an index that essentially has middle-sized companies. So as these companies are going up the indexes, which is where I've talked before in the podcast about asset allocation, is owning different types of index funds and different types of ETFs. You can very simply just buy a total stock market fund, and you're going to get fine exposure. You're going to get exposure, but when you buy, mid-cap indexes and small-cap indexes, and we haven't even really talked about international at all, you're starting to buy more and more and more of the market, and it's a huge market out there. And so when you talk about, there's everybody, when you hear the market on the way home and you hear the NASDAQ, the Dow Jones, and the S&P 500, that's really a pretty tiny footprint as to the number of companies, but they're big.
Yes. Yes. And asset allocation is the most critical part of, portfolio management.
It's not market timing?
It's not market timing.
No one want to get in and out?
It's not market timing. Yeah.
So what do you think of the beer?
I like it.
Yeah.
I like it. Yeah. It's
Austin Brothers.
nice and crisp.
So I picked this up because, one, as the regular listeners know, I prefer my Michigan beers unless somebody sends me something from out of state. But I actually have a good story with this beer. Is that the first time I ever tried it was on draft up at the 45th parallel in beautiful Alpena. I went up there fishing with my cousin. We limited out by noon, so we hit the boat launch and we found a local eatery that happened to be basically right down the road from Austin Brothers, and had Austin Brothers 45er on tap. But that's going to wrap up this week's episode of Prosperity by the Pint. Thanks for tuning in. Don't forget to subscribe to Spotify, iTunes, YouTube, Facebook, wherever you listen. That's where we are. Cheers. Thanks for coming, Mike.
Bye.